Welcome back to another lesson. We continue with our revision series, and in this video we are looking at an exam that was done in June 2021, Chrp 04, Introduction to Financial Accounting. And our focus is question number 6. This question reads, the following transactions are from the books of Good Luck Traders for the month of April 2021. We have the balances that were brought down. We have capital, bank, cash, purchases, and were paid by check, sales, and were paid by check, sales, some were paid by cash, general expenses paid by check, sold good and receiver check, paid for repairs by check, bought furnitures by cash, received check for interest. And then you're told NB balance of furniture on 1st April, that is the beginning, was 124,500. You are required to enter the above transaction in the relevant accounts. So we have to prepare ledgers for each and every item here. I will start in order. Let me first prepare the first account I can see. Let's start with furniture account. Furniture account. Furniture account, 1st April, there was a balance brought down of 124,500. Remember, furniture is an asset, then the balance brought down will be on the debit side. There is balance BD, 124,500. Now, let me start from the top. Having captured that, you are told that there is balances for capital. So I come here and open capital account. Capital account. Capital has a credit balance. Therefore, the balance brought down is on the credit. Balance brought down, that is 1,075,000. I also need to open a bank account. There are balances for bank. Come here and open bank account, and this is still on 1st April. 1st April, there is balance brought down. Balance brought down for bank is how much? 851,000. 851,000. I also need to open this is cash account. I come and open cash account. Cash account. Remember, this side is debit, this side is credit. Debit, credit. All of them. This is debit, credit. Debit, credit. Now, cash account has a balance of 122,500. Cash is an asset, so balance brought down 122,500. That is 122,500. I'm done with the April 1st. I move on to April 9th. You are told made purchases and paid by check. So what do you do here? You are going to open a purchases account. You are going to open a purchases account. Remember the accounting rule. For any debit, there is a corresponding what? There is corresponding credit. Now, when you make purchases and pay by check, means that this amount is getting out of bank. So I'm going to credit bank with purchases of how much? Bank, I'm going to credit bank with purchases of 216,000. Similarly, I come and debit purchases with bank 216,000. Next, you are told that sales paid by check. When you make sales, you are going to create sales account. When you make sales, you are going to create sales account. And remember, the payment is made by check. So you credit sales. Sales is credited. You credit sales with the figure. You told that sales paid by check, that is 463,000. That is on April 10th. 463,000. Sales paid by check, 463,000. Then you move on to when you are paid by check, means the money goes to bank. You come to bank and debit sales, 463,000. You debit sales with 463,000. There is also sales paid by cash. So when you make sales, you come here and credit this with cash. How much cash made there was 18, sales paid by cash 81,500. 81,500. Do you have a cash account? No. Yes, we have a cash account here. We had a balance. We had opened a cash account here. It had a balance brought down. So you come here and debit with sales. You debit that with sales of 81,500. 81,500. So that is the corresponding account for sales. Now, we move to April 16, paid general expenses by check. That means I need general expense account. It means I need general expenses account. General expenses account, expenses are debited. And here we are talking of paid general expenses 27,000 by check. So I go to bank and credit general expense. General expenses, that is 27,000. I come to general expenses, and I debit bank with the 27,000 because the payment were made through bank. We move on and we go to April 24th, sold goods and received a check 331,000. So that means you go to sales and this money go to bank, 331,000. You sold good on this date, 331,000, and receive, so sales 331,000. That is the corresponding account for this. Now, we go to April 26, paid for repairs by check. So we are going to have repair and maintenance account. Repairs account. This is an expense. Then you are going to, it's been paid by check. How much? Been paid by check. Paid for repairs by check, 325,000. 325,000. So this is an expense account, 325,000. Then the bank is the one that is going to pay that. So repairs, 325,000. The bank is the one that is going to pay that. Then bought furnitures by cash. So that means the amount of cash goes. So here cash account, it goes to furniture. And how much? Bought furnitures by cash, 27,500. Then you go to furniture and debit. Go to furniture. What is furniture? Furniture was the first account we had. Furniture, and we debit this one with cash. This is 27,500. 27,500. Finally, you are told received a check for interest. You see, when you receive interest, this is an income. You have to create interest income account. You come here and create interest income account, and income is credited. Income is credited. So how much are we crediting? Interest was 73,500. That is 73,500. And this money went to bank. This money went to bank, and it is interest income. Interest income of how much? Interest income 73,500. 73,500. You see the interest account. I also have 73,000. Now, once you open up your accounts, you need now to close them. Close them by getting the totals here. This is 124,500 plus 27,500. This gives me 152,000. So balance carried down 152,000. Close this account, 152,000. If you are to prepare your trial balance, the figures come here. Balance brought down 152,000. We come here. Capital has no adjustment, 1,075,000. Balance carried down 1,075,000. Close this account, 1,075,000. Then balance brought down 1,075,000. When you come to bank, we have to make these adjustments. Add this 851,000 plus 463,000 plus 331,000 plus 73,500. This give me debit side 1,718,500. Of course, there will be balance carried down here. Let's see how much, because you can see the figures on the debit side is greater, 1,718,500. Let's see how much. Minus 216,000. This is 27,000. Then minus 325,000. So the balance carried down here is 1,150,500. So balance brought it down here is 1,150,500. Come here, close this. 122,500 plus 81,500. This give you 204,000. 204,000. So balance carried down minus 27,500 is 176,500. Close this account, 204,000. Then you have balance brought down 176,500. We move on to purchases. There are no adjustment. This is 216,000. Balance carried down 216,000. Close this account, 216,000. Balance brought down 216,000. This goes to trial balance. On the sales, they are not this. You add all this, 463,000 plus 81,500 plus 331,000. This gives you 875,500. Balance carried down 875,500. Close this account, 875,500. There is 500 here, 875,500. So balance brought down 875 500. Repair and maintenance, just close it down. It has a single entry. Balance carried down 325,000. Close this, 325,000. Then balance brought down 325,000. General expenses, just close this account, 27,000. Balance carried down 27,000. 27,000. Balance brought down 27,000. And finally, we have the interest income. This is 73,500. Balance carried down 73,500. Close this account, 73,500. Balance brought down 73,500. So that is it. That's how we prepare the relevant ledgers and relevant accounts for this question. Unless there is a clarification for now. Let's move on to part B. Part B, you are told that explain the following terms as used in accounting. What is accruals? When you're talking about accruals, is a means of recording. It's a means of recording an expense that was incurred in one accounting period, but not paid for, until a future accounting period. So those expenses that have not been paid for by the end of the accounting period, they are referred to as accruals. Yeah. Now, the next part is the prepayments. These are the payments made in advance. Prepayments, we are seeing that is an amount paid by a business, in advance of the goods and services, being received at a later date. So in other words, we are saying that any payment made in advance, any payment made in advance, they are called prepayments. Yeah. Next, you are asked to explain what is depreciation. Sorry. What is depreciation? You see, we normally say assets are depreciated at this rate, but what is this depreciation now? We are saying that it's an accounting practice. Used to spread the cost of an asset, the cost of a tangible or physical assets over its useful life. Yeah, the cost of assets. In other words, we are saying that depreciation represents how much the asset value has been used up in any given time. How much the asset value has been used up, in any accounting period, Then we have bad debts recovery. Bad debts recovery is a payment received for a debt that was declared as a bad debt, for debt that had previously been written off, and considered as uncollectible, So when that debt is recovered, then we say that those are bad debts recovery. Finally, you explain what are adjusting entries. These are entries that you use to make adjustment to your financial records. Adjusting entries. We are saying that our financial records you can use to track unrecorded transaction. You can use to track unrecorded transaction. E.g., you have accrued expenses. They are adjusting entries. Accrued expenses. You can have accrued revenues. You can have deferred income. Deferred revenue, etc. Yeah, those are the explanation that were necessary for you to score all the available marks. Otherwise, we are going to stop there. We meet in our next video. So for now, it's a goodbye.